Hello, everyone. Troy Thompson here, the Angel of Freedom. And today, rules of 10. So, three rules about rule of 10 for your financial life. So, let's get right into it. Rule number one is give 10% to church or charity. So, each month you earn your income. And wages are the easiest scenario, whatever your increase was, whatever your profit was, whatever you actually got paid. 10% to church and charity, church or charity. So I can remember when I was 22 years old and I started as a client with a financial advisor or financial advising company. And this was something that they encouraged and that I did not follow. And then around the 2007 time period, I read Rich Dad, Poor Dad by Robert Kiyosaki. And then I read all the books that he had out at that time. And he talked about the rule of 10%, of giving 10% to church or charity and doing that first, doing that as the first expense of the month. And the concept is basically the idea of an abundance mindset. So when I am regularly giving 10%, then my mindset is I have enough. And the other 90% is enough for me to live on. And so it creates this mindset of abundance. And an example, an illustration that I heard is think of taking your hands and scooping up a bunch of sand in each hand and squeezing it and holding it really tight. What would you be left with? Very little. You would squeeze out most of the sand. Contrast that to taking both hands and working together and putting them in the sand and holding them in a cupping shape. And I can hold a lot more sand in that scenario. And so the thinking is by this cupping that I'm allowing money to flow into my life. I have more than enough, and I have more than enough in an effort in a way that I can give 10% to church or charity. Rule number two is pay yourself 10%. So, very common financial principle. Unfortunately, not that common to be followed. The Richest Man in Babylon is one book, probably of many, that talks about this concept of giving my future self 10%. So the first two payments that I encourage people to do in their month, 10% to church or charity, whatever it is that is important to them, and then 10% to the future self. And then living on the other 80%. And for those that are younger, especially just starting out, as much as 50% if possible is really good and a good practice to have. What I've seen in my own life and clients as well, as the years go by, it can become more difficult to maintain the 10% to church or charity and 10% to my future self. Why is that? Well, life gets expensive, especially around the 40s. Obviously, that's going to depend on whether a person has children or not, when they have children, how many children they have. But statistically speaking, the 40s are peak spending years and maybe into the mid 50s. That's why they have those catch up years for IRAs, where an individual can put more money into an IRA or their 401k when they're over 50. So the thinking is in the 50s, and that's typically when children would be out of the house and there wouldn't be as much in the way of expenses. And so by developing the habit at a young age of putting away at least 10% helps establish that pattern. So then that way, when life gets more expensive, then the pattern is already there to give away 10% to church or charity and invest, save 10% for my future self. And then the third rule of 10 is that 10% that I put away each month, get that money to earn a 10% return. And so then let's say if I start with $100 and I get 10%, now I have $110 that's working for me. And then $110 can get 10%. And so now I earned 11% interest. Now you might be thinking, well, 10% every single year, that's a bit unrealistic. Well, it is realistic depending on the person and the investment. Greater than the return is the concept of getting a return on the money and getting the compounding to work. Many of you have probably heard that story before of, Well, would you rather have $1 million today, or would you rather have a penny that's doubled each day for 30 days in a row? So day one, a penny, day two, 2 pennies, day three, four, and so on, and keep doubling. And in that doubling manner, you end up with way more money after 30 days than the $1 million up front. And so this is to illustrate the compounding effect. And that makes me think of The Compound Effect by Darren Hardy. That's another great book that takes the concept of compound interest and shows it in all aspects of our lives. So that's the quick short video for today. The rules of 10. First, pay 10% to church or charity. Second, 10% to your future self. And third, earn 10% on that money.